CFA Level 1 Practice Questions. Learning Module, Topics in Long-Term Liabilities and Equity. Topic, Leases. A company enters into a 5-year lease for office space. Under both IFRS and US GAAP, which of the following statements about the lessee's accounting at the lease commencement date is most accurate? A right-of-use asset and a lease liability will be recorded on the balance sheet only if the lease is classified as a finance lease. B, a right-of-use asset and a lease liability will be recorded on the balance sheet regardless of whether the lease is classified as finance or operating. C, a right-of-use asset and a lease liability will be recorded only if the lease is for a high-value asset and is classified as an operating lease. Correct answer, B. Under both IFRS and US GAAP, the standards require lessees to recognize a right of use, ROU, asset and a corresponding lease liability on the balance sheet for almost all leases at the commencement date. This requirement applies universally to both finance and operating leases, with only limited exceptions, for example, short-term leases of 12 months or less and leases of low-value assets. The recognition is based on the fundamental principle that a lease transfers the right to control the use of an identified asset for a period of time in exchange for consideration, thereby creating both an asset, ROU, and a liability, obligation to make lease payments. A, incorrect. The statement reflects the old accounting standard, which has been superseded by the current standards. Under the old standard, operating leases were treated as off-balance sheet financing, meaning no asset or liability was recorded, while finance or capital leases were recorded on the balance sheet. However, under the current standards, this distinction has been eliminated for most leases, requiring recognition of both ROU assets and lease liabilities for both finance and operating leases, except for the limited exceptions mentioned. C, incorrect. The statement incorrectly implies that recognition depends on the asset being high value and classified as an operating lease. In reality, recognition is required for most leases regardless of asset value or lease classification, except for short-term leases, 12 months or less, and, under IFRS only, leases of low-value assets. The standards do not limit recognition to high-value assets. Instead, they focus on the lease term and nature, with the goal of ensuring transparency and comparability in financial reporting. The distinction between finance and operating leases under both IFRS and US GAAP primarily affects the subsequent measurement and expense recognition patterns, not the initial recognition of the ROU asset and lease liability. For finance leases, interest and amortization are presented separately on the income statement, resulting in a front-loaded total expense. For operating leases, a single, straight-line lease expense is reported on the income statement over the term of the lease. Limited exceptions exist for short-term leases and leases of low-value assets, where lessees may elect not to recognize the ROU asset and lease liability. However, these are exceptions to the general rule and do not change the fundamental requirement for recognition in most cases. A manufacturing company leases a piece of specialized equipment to a customer. The lease is classified as a finance lease from the lessor's perspective. At the lease commencement date, which of the following is the most accurate accounting treatment by the lessor? A, recognize a lease receivable and continue to depreciate the equipment. B, to recognize the equipment in recognize a lease receivable. C, continue to carry the equipment on its balance sheet in recognize lease revenue as payments are received. Correct answer, B. A finance lease transfers substantially all the risks and rewards of ownership to the lessee. From the lessor's perspective, this is treated like a sale. The lessor removes, derecognizes, the leased equipment from its balance sheet. The lessor records a lease receivable equal to the present value of future lease payments. The lessor stops depreciating the equipment because it is no longer owned for accounting purposes. Any profit or loss on the sale is recognized at the lease commencement date. A, incorrect. You cannot both remove the asset from the balance sheet derecognize it, and continue to depreciate it. Depreciation only applies to assets the company still owns and carries on its books. Continuing to depreciate would imply the lessor still retains ownership risks, which contradicts the finance lease classification. See incorrect. This describes accounting for an operating lease, not a finance lease. In an operating lease, the lessor retains ownership and continues to depreciate the asset. Revenue is recognized as payments are received, similar to a rental agreement. For a finance lease, the lessor must derecognize the asset and recognize a lease receivable instead. Finance lease, treated like a sale. Asset is derecognized. Lease receivable is recorded. Operating lease, asset remains on the balance sheet. Lease revenue is recognized over time. Depreciation only applies to assets the company owns and carries on its books. Stop for finance leases because the asset is derecognized. Lease receivable represents the present value of future lease payments, recorded instead of the asset for finance leases. Revenue recognition. Finance lease, profit or loss recognized at commencement. Operating lease, revenue recognized as payments are received. A lessor enters into a lease agreement for equipment with a fair value of $1 million and a carrying value of $700,000. Under U.S. GAAP, the lease is classified as a sales-type lease. The present value of the lease payments is $1 million. What amount of profit, if any, will the lessor most likely recognize at the lease inception date? A $0. B $300,000. C $1 million. Correct answer, B. Under U.S. GAAP, a sales-type lease is treated like a sale of the asset by the lessor. The lessor recognizes sales revenue equal to the fair value of the asset, $1 million. Cost of goods sold equal to the carrying value of the asset, $700,000. Profit is calculated as sales revenue minus cost of goods sold. Profit equals $1 million minus $700,000 equals $300,000. This matches the economic reality that the lessor has effectively sold the asset for more than its book value. Sales type lease versus direct financing lease. Sales type, profit recognized at inception. Difference between fair value and carrying value. Direct financing, no profit recognized at inception, fair value equals carrying value. Profit equals revenue minus cost. Revenue recognition, fair value of asset or PV of lease payments. Cost recognition, carrying value of the asset. Sales type lease represents an actual sale with economic gain. The profit reflects this economic gain in accounting terms. Must recognize both sides of the transaction, revenue and cost. A company leases out a warehouse under a contract classified as an operating lease. Which of the following best describes the impact of this lease on the lessor's financial statements over the lease term? The lessor derecognizes the warehouse and recognizes a lease receivable. B. The lessor recognizes a selling profit at lease inception and interest revenue over the lease term. C. The lessor continues to report the warehouse as an asset and recognizes depreciation expense. Correct answer, C. Under an operating lease, the lessor retains ownership and control of the asset. The warehouse remains on the lessor's balance sheet as a long-term asset. Depreciation expense is recognized over the asset's useful life, not just the lease term. Lease income is recognized on a straight-line basis over the lease period. This treatment reflects that the lessor is simply renting out the asset, not selling it. The lessor continues to bear the risks and rewards of ownership. A. Incorrect. This describes finance lease accounting, sales type, or direct financing, not operating lease. Derecognition occurs when control transfers to the lessee, finance lease characteristic. An operating lease, the lessor maintains control and ownership risks. No lease receivable is created in operating lease accounting. The asset stays on the lessor's books throughout the lease term. B. Incorrect. This describes sales type lease accounting, a type of finance lease. Selling profit recognition indicates a sale has occurred, not true in operating lease. Interest revenue recognition is for financing arrangements, not operating leases. Operating leases are treated as rental agreements, not sales. No profit is recognized at inception. Revenue is recognized over time. In operating lease, lessor retains ownership risks or rewards. In finance lease, control transfers to lessee. On balance sheet for operating lease, asset remains on lessor's books. On balance sheet for finance lease, asset is derecognized, receivable is recorded. An income statement for operating lease, straight line rent revenue, depreciation expense. An income statement for finance lease, profit at inception, interest revenue over time. Operating lease is a rental agreement. Finance lease is effectively a sale with financing. Which of the following characteristics is most indicative of a finance lease, as opposed to an operating lease? The lessee has the right to use the asset for a period that is insignificant relative to the asset's total economic life. B. The present value of the lease payments is substantially less than the fair value of the underlying asset. C. The lease agreement contains a bargain purchase option that the lessee is reasonably certain to exercise. Correct answer, C. A finance lease transfers substantially all risks and rewards of ownership to the lessee. A bargain purchase option allows the lessee to buy the asset at a price significantly below fair value. If reasonably certain to exercise, this indicates the lessee will effectively own the asset. This meets the core criterion of a finance lease, transfer of control or ownership. The certainty of purchase demonstrates the economic substance of a purchase. A. Incorrect. This describes an operating lease, not a finance lease. Insignificant use period indicates temporary access, not ownership transfer. Finance leases typically involve use for a major part or all of the economic life. Short-term use suggests risks or rewards remain with lessor. This is the opposite of a finance lease. B. Incorrect. For finance lease classification, PV of payments should equal or exceed substantially all of fair value. Substantially less indicates lessee isn't paying for most of asset's value. This suggests lessor retains significant residual value risk. More characteristic of operating lease where asset isn't effectively being purchased. Finance leases require economic substance of a purchase through payment structure. Finance lease, transfer of ownership risks or rewards. Operating lease, temporary use with risks or rewards retained by lessor. Core finance lease criteria. Ownership transfer, bargain purchase option. Major part of economic life, substantially all fair value paid. No alternative use to lessor. Finance leases are effectively purchases. Operating leases are effectively rentals. Look for indicators of ownership transfer. For a lessee with a long-term finance lease under U.S. GAAP, how is a periodic lease payment allocated on the income statement after lease inception? The payment is allocated between interest expense and amortization of the right-of-use asset. B. The entire payment is recognized as a single, straight-line lease expense. C. The payment is allocated between a reduction of the lease liability and interest revenue. Correct answer, A. Finance leases are treated like finance purchases under U.S. GAAP. Two distinct expenses are recognized on the income statement. Interest expense represents cost of financing the lease liability. Amortization expense represents consumption of the right-of-use asset. This dual recognition reflects economic substance of financing an asset purchase, matches the accounting treatment for purchased assets with debt financing, results in front-loaded expense pattern, higher interest in early years, provides more detailed financial information than operating lease approach. B. Incorrect. This describes operating lease accounting, not finance lease. Finance leases require separation of financing and asset consumption costs. Single-line approach masks the economic substance of financing. Doesn't distinguish between interest cost and asset usage. Less informative for financial statement users. Only appropriate when risks-rewards haven't substantially transferred. Operating lease. C. Incorrect. Lessees don't recognize interest revenue. This is a lessor concept. Lessee is borrower, not lender, in finance lease arrangement. Should recognize interest expense, not revenue. While principal reduction is correct, it's paired with wrong income statement item. Shows fundamental misunderstanding of lessee versus lessor accounting. Would misstate financial results if incorrectly applied? Finance lease accounting fundamentals. Treats lease like asset purchase with financing. Requires separation of financing costs, interest, and asset costs, amortization. Matches expenses with periods benefiting from asset use. Operating lease. Single expense line, no asset liability recognition. Finance lease. Dual expense recognition, asset liability on balance sheet. Finance lease accounting reveals financing arrangement. Provides better information about obligations and costs. Aligns with principle of matching expenses with revenues. On balance sheet, finance leases create both asset and liability. Payments reduce liability and cash. Amortization reduces asset value over time. A lessee enters into a 4-year lease for machinery. The annual lease payments are $2.5 million, payable at the end of each year. The lessee's incremental borrowing rate is 6%. The present value of these lease payments, discounted at 6%, is $8.66 million. The machinery has a fair value of $9.1 million. What amount should the lessee report as a lease liability on its balance sheet at the lease commencement date? A. $2.5 million. B. $8.66 million. C. $9.1 million. Correct answer, B. The lease is a finance lease, though the specific classification details aren't directly relevant to calculating the initial liability amount. Under both U.S. GAAP and IFRS, a lessee's lease liability is defined as the present value of the future lease payments. At the lease commencement date, the lease liability is initially measured at this present value. A right of use ROU asset, generally equal to the lease liability, adjusted for initial direct costs, prepayments, or incentives. In this case, we are given that the present value of the lease payments, discounted at the lessee's incremental borrowing rate of 6%, is $8.66 million. This present value calculation already takes into account the timing and amount of the lease payments, $2.5 million per year for 4 years at the end of each year, and the discount rate. The fair value of the machinery, $9.1 million, is not relevant to the calculation of the initial lease liability. The fair value may be used in other aspects of lease classification or subsequent measurement in some cases, but for determining the initial lease liability, we focus on the present value of the lease payments. So the lessee should report $8.66 million as a lease liability on its balance sheet at the lease commencement date. From a lessee's perspective, which of the following is a primary advantage of leasing an asset compared to purchasing it with debt? A. It allows the lessee to avoid recognizing any liability on its balance sheet. B. It typically requires a significant upfront cash outlay for a down payment. C. It transfers the risk of asset obsolescence away from the user of the asset. Correct answer, C. The main advantage of leasing is risk transfer, particularly the risk that an asset becomes outdated or obsolete. When you lease, the lessor bears the residual value risk if the asset loses value due to technological advancement. At lease end, the lessee can return the asset and upgrade to newer equipment without being stuck with outdated property. This is especially valuable for rapidly changing assets like technology equipment and vehicles. If you purchase an asset, you own it and bear the full financial loss when it becomes outdated. If you lease an asset, you can walk away at lease end and upgrade without selling obsolete equipment. The lessor prices this risk into lease payments, but the lessee avoids unpredictable obsolescence losses. This provides flexibility and protects against being locked into outdated assets. A. Incorrect. Before 2019, operating leases were off balance sheet, with only footnote disclosure required. Now, lessees must recognize both a right of use asset and a lease liability for virtually all leases over 1 year. This eliminated the off-balance sheet treatment that was previously a major motivation for leasing. Modern leasing and purchasing with debt both result in similar balance sheet recognition. B. Incorrect. Option B states leasing requires significant upfront cash, which is backwards. One of leasing's advantages is that it typically requires little or no upfront cash outlay. Purchasing with debt usually requires a substantial down payment, often 10 to 20% or more. Leasing spreads payments over time, preserving working capital and cash flow. A company that manufactures specialized medical imaging devices leases a unit to a hospital. The lease is classified as a finance lease. The present value of the lease payments is $2 million. The device cost the company $1.5 million to manufacture. At the lease commencement date, the lessor will A. Remove the $1.5 million asset from its balance sheet and record a $2 million lease receivable. B. Keep the $1.5 million asset on its balance sheet and begin recognizing straight-line lease revenue. C. Remove the $2 million asset from its balance sheet and record a $2 million lease receivable. Correct answer: A. Finance lease treatment by lessor. In a finance lease, the lessor treats the transaction as a sale of the asset, not a rental. The lessor transfers substantially all risks and rewards of ownership to the lessee. At lease commencement, the lessor derecognizes the asset and recognizes a receivable. This is often called a sales-type lease when the lessor is a manufacturer or dealer. $1.5 million equals the manufacturer's cost, carrying value on the books before the lease. $2 million equals the selling price, present value of what the hospital will pay. The asset comes off the books at $1.5 million, what the lessor paid to make it. The receivable goes on the books at $2 million, what the lessee will pay. The 50 cents million difference is the manufacturer's profit margin. B. Incorrect. Option B describes operating lease accounting, not finance lease accounting. In an operating lease, the lessor keeps the asset on the balance sheet. In an operating lease, the lessor recognizes rental income over time on a straight-line basis. Finance leases are fundamentally different because they transfer ownership risks and rewards. Finance lease: asset removed, receivable recorded, immediate profit recognition. Operating lease: asset retained, depreciation continues, rental income over time. Finance lease: treated as a sale with financing. Operating lease: treated as a rental arrangement. A company reporting under IFRS enters into a 4-year lease for a vehicle on January 1st, year 1. The lease requires annual payments of $30,000, with the first payment due at the commencement date. The company's incremental borrowing rate is 7%. The vehicle has a useful life of 6 years. The present value of the lease payments is $108,500. The total expense related to this lease that the company will report on its income statement for year 1 is closest to at $27,125. B. $30,000. C. $32,620. Correct answer: C. Under IFRS, lessees use a single accounting model for all leases, no distinction between finance and operating leases for lessees. All leases result in recognizing a right of use, ROU, asset and a lease liability on the balance sheet. Income statement expense consists of 2 components: depreciation, amortization of the ROU asset, and interest expense on the lease liability. These 2 components are reported separately on the income statement. The first payment of $30,000 is due at commencement, January 1st, year 1. This payment immediately reduces the lease liability before any interest accrues. The lease liability for calculating year 1 interest equals $108,500 minus $30,000 equals $78,500. If the first payment were due at year-end instead, the liability would remain $108,500 for the full year. The ROU asset is recorded at the present value of lease payments, $108,500. The ROU asset is depreciated over the lease term, 4 years, not the useful life, 6 years. Use the lease term because the company only has the asset for 4 years, not 6 years. Annual depreciation. $108,500 divided by 4 years equals $27,125. Initial lease liability, $108,500. After first payment at commencement, $108,500 minus $30,000 equals $78,500. Interest is calculated on the remaining liability after the first payment. Interest expense for year 1 equals $78,500 times 7% equals $5,495. This represents the time value of money cost for the outstanding lease obligation. Year 1 total expense equals $27,125 depreciation plus $5,495. Interest equals $32,620. Both components appear on the income statement but in different line items. Depreciation typically appears in operating expenses. Interest appears in finance costs. From the perspective of a lessee, which of the following is least likely to be a direct economic advantage of leasing an asset instead of purchasing it? A. The transfer of asset obsolescence risk to the lessor. B. The ability to claim tax deductions for depreciation expense. C. The preservation of the company's lines of credit with its bank. Correct answer, B. When a company purchases an asset, it owns the asset and can claim depreciation deductions over the asset's useful life. This reduces taxable income and thus tax liability. In a lease for an operating lease, the lessee deducts lease payments as an expense, not depreciation. The lessor, as the owner, claims depreciation. For a finance lease, the lessee depreciates the right of use asset, but this is similar to the situation of a purchaser. There is no unique advantage in terms of depreciation deductions for leasing over purchasing. The tax treatment can be complex and may not always favor leasing. So this is not a direct economic advantage unique to leasing. A. Incorrect. Asset obsolescence risk refers to the risk that an asset will become outdated or less valuable before the end of its useful life. When a lessee leases an asset, especially technology, related assets, the lessor, being the owner, bears this risk. For example, if a new version of software or equipment is released, the lessee can return the old leased asset and lease the new one. This is a major advantage of leasing as it protects the lessee from being stuck with an obsolete asset, which is a common problem for asset purchasers. C. Incorrect. When a company purchases an asset, it often needs to take out a loan, which can tie up a significant portion of its available credit lines with the bank. By leasing an asset, the company can avoid using up these credit lines for the asset purchase. This preserves the company's financial flexibility, allowing it to access credit for other business needs such as working capital, expansion, or unexpected expenses. This is a direct economic advantage of leasing as it helps the company maintain its borrowing capacity. A primary economic reason for a company to lease an asset rather than purchase it outright is most likely to A. Improve its reported debt-to-equity ratio under current accounting standards. B. Transfer the risks of asset ownership, such as obsolescence, to another party. C. Recognize a higher net income in the early years of the asset's use. Correct answer, B. Risk transfer is a core economic benefit of leasing. By leasing, the lessee does not own the asset and thus avoids risks like obsolescence, residual value fluctuations, and disposal costs. This is especially valuable for assets that quickly become outdated, such as technology or certain equipment. The lessor retains ownership and bears these risks, making leasing attractive for companies seeking to minimize uncertainty. The primary economic reason for leasing is to transfer ownership risks, such as obsolescence, to the lessor. Improving the debt-to-equity ratio is not a valid reason under current accounting standards, due to capitalization requirements. Recognizing higher early net income is not a consistent or primary benefit of leasing. A. Incorrect. Under current accounting standards, IFRS 16 and US GAAP ASC 842, most leases are capitalized on the balance sheet. This means a right of use, ROU, asset and a corresponding lease liability are recorded, effectively increasing reported debt. Leasing no longer provides the off-balance sheet financing benefits it once did under older standards. Therefore, improving the debt-to-equity ratio is not a valid economic reason for leasing under current standards. C. Incorrect. Lease accounting does not consistently result in higher early period net income. For finance leases, which resemble asset purchases, total expenses, interest plus depreciation, are typically higher in the early years due to front-loaded interest. For operating leases under current standards, expenses are recognized on a straight-line basis, but this does not necessarily lead to higher net income compared to purchasing. The focus on maximizing early net income is not a reliable or primary economic reason for leasing.